Dear learners, welcome to this lecture. In this lecture, we will discuss about financial management. This is Unit 14 in Block 4 of your course TS3. If we want to start a new business, or if you want to start a new organization, or if you want to open a firm, there are some decisions that need to be taken beforehand. The first and foremost decision is about the finance, or from where the money will come, how the money will be spent, and what will be the sources of funds. So another decision is what will be the product and how it will be sold to the customers. So the decision with regard to what will be the product and how it will be sold, it is under marketing part. And the very first decision from where the money will come or how the money will be spent, that is basically deals in the financial management. So in this first lecture we will discuss about the basics. We will try to understand the meaning of the word finance and various financial functions. Then we will understand the concept of financial management. Then we will try to understand the tasks involved in the financial management, and in the end we will understand what is financial planning. So the very first thing, what is finance? It is pronounced as finance or finance. So the first thing, the dictionary meaning of what is finance, that is the management of money and other assets, or it is the science of management of money and other assets of the business. So that is the meaning, dictionary meaning. In the dictionary also this word is defined as noun or as well as the verb. There is one more term that we generally used to listen or used to hear in our day-to-day conversation, that someone has purchased a particular product or someone has purchased a particular service on finance. So in that sense, the word finance, it also means the kind of arrangement that allows a customer to purchase an item without paying the full amount. So what is the meaning when someone says that I have purchased this car, or I have purchased this laptop, or I have purchased this particular item on finance? Means he has not made the full payment. He has made some amount of the payment and some payment is still pending, which he will be paying in the equated monthly installment we popularly know as EMI. So in the dictionary meaning, if we define this word finance or finance as a noun, then it is simply the management of money and other assets, or it can be defined as the science of management of money and other assets, or it can be defined as the kind of arrangement allowing a customer to purchase an item without paying the full amount. That is the meaning of this word finance as noun. If we define it as a verb, means the action, then it is basically about to procure, allocate and monitor the deployment of money and other assets. See, in the dictionary itself, this word finance has been defined, or it has been defined as a noun or as a verb. So in case of noun, it is the management or science of money and other assets, or it is the kind of arrangement that allows a customer to purchase an item without paying the full amount. And in case of as a verb, if we want to define, then it is the process, or it is the action, or it is the act to procure, allocate and monitor the deployment of money and other assets. There are three functions, that is the procure, means how to get the funds, then to allocate, how to deploy those funds, and how to monitor the deployment of those money and other assets. That is again the meaning of the word finance as a verb. So for a business, funds need to be procured. It means raised. They can be raised from long term as well as short term sources. Then the funds, they need to be allocated for various activities. Then they need to be used effectively. Then their use need to be monitored and the results need to be recorded. So these are basically the financial functions of any business. The first function is procurement or raising the funds, means how to arrange the funds. The funds, they can be arranged from the long-term sources as well as from the short-term sources. Means here the word long-term or short-term means the repayment. If we need to repay the funds in a shorter time of span, then those sources are short-term sources, and if we need to repay the funds in a longer span, then these sources will be the long-term sources. So the very first function is procurement of funds, and in this function we need to take a decision how much of the funds need to procured from long-term sources, how much of the funds procured from the short-term sources. The next part is allocation of the funds for various activities. In case of business, we have various activities. Some are day-to-day expenses, some are the expenses that are related to expansion of business. So we need to take a decision on how much of the funds that we have procured or raised from long-term as well as short-term sources we need to allocate for the day-to-day functioning of the business, and how much of the funds we need to allocate for the other activities like expansion of business, etc. Now we have procured and we have allocated the funds. So we need to ensure that these funds are used effectively. Then we need to also to monitor the use of these funds, like the funds are being used for the purpose for which they were allocated and the purpose is being met or not. If there are any changes, then we need to take the corrective measures. And the last is the results need to be recorded. What are the results of deployment of the funds? We need to record it into the books for future reference as well as for the legal purposes also. So if we arrange these financial functions, then there are three separate but overlapping dimensions. The first is financial accounting, the second is management accounting, and the next is financial management. These basically all the financial functions of the business, they come across either financial accounting, management accounting, or financial management. These are not entirely separate dimensions, these are overlapping dimensions. Some aspects of financial accounting they interacts with the management accounting as well as financial management, or some aspects of the management accounting they also interacts with the financial accounting and financial management. So these are separate yet overlapping dimensions of the financial functions of any business. Now we will go into the detail of each of these dimensions. The first is financial accounting. So financial accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character, and interpreting the results thereof. This is the definition of financial accounting that has been given by the American Institute of Certified Public Accountants. Let us understand this definition. Financial accounting is the art of, first thing is recording, means we need to record, we need to write somewhere. Once we have written, once we have recorded, the another aspect is classification. Classifying means we collect or we group the similar transactions at one place. And then next aspect is summarizing. See, first we record, then we make groups, that is the classification part. Then we prepare the summary for each group in a significant manner, means the process by which these are recorded, classified and summarized, it is a significant manner, means there are some generally accepted accounting principles. And which transactions are to be recorded, classified or summarized? The transactions which have monetary characteristics or which can be expressed in terms of money transactions, or the events of the business which are in part at least of a financial character, that need to be recorded, classified and summarized in a significant manner by way of following the generally accepted accounting principles, and then to interpret the results. So there are some important aspects, that is, first of all, what we need to record: the transactions which are there in terms of money, that is the transactions which are money transactions, or the events which have at least some sort of financial characters. These need to be recorded, then classified and then summarized in a significant manner, means by way of following some generally accepted accounting principles, and then the results of this summarization is interpreted. So what are the various functions that we perform in the financial accounting? We prepare a journal book. Journal means a day book wherein all the daily entries of the business they are written. Or we prepare various subsidiary books like sales book, cash book, purchase book, etc. So this is the first part, wherein we are recording the transactions either in the journal, or either we are recording the transaction on the basis of subsidiary book, like a sale transaction that will be recorded in the sales book. If there is a purchase transaction, it will be recorded into the purchase book. If there is a cash transaction, it will be recorded in the cash book. Journal means the daily entries. So this is the recording part. Then we prepare a ledger. In case of ledger, we classify the transactions that we have recorded into the journal or various subsidiary books. Means the similar transactions related to one specific individual or having some similar nature, they are placed on a single page on the ledger. That is basically known as the ledger folio or the ledger account of that particular individual, that particular organization, or that particular nature. Then what was the next part? That was the summarizing. Then we summarize the entire the ledger page, and we prepare a trial balance, and then we prepare the final accounts, that is basically the profit and loss account and balance sheet. So if we compare these two things, that is the definition of the financial accounting and the functions. The first part is the recording part, which is being done by the way of writing the transactions in journal or the subsidiary books. The second part was the classification of the transactions, that is being done by shifting the transactions from the journal or subsidiary books to the ledger. Then the next part was summarizing, that is basically we prepare the trial balance, and all these aspects they are done in a significant manner with some generally accepted accounting principles. And what is the common in all these? These are money transactions or the events, business events, which have some financial characteristics. And in the end, we have said that we have interpreted the results. So we have prepared the final accounts, that is the profit and loss account or the balance sheet. The profit and loss account, it gives us the idea about the gross profit or gross loss of the business operations in a given time period. And also we prepare the balance sheet, which gives us an idea about the assets and liabilities of the business. So see, the financial accounting in itself is a separate discipline. Here we are dealing just with the definition and the functions, that too in the broader way. When I am talking about that, there is a significant manner generally accepted accounting principles that are followed. So that is you will study it in the detail in your financial accounting paper. Next is management accounting. See, in the financial accounting, we have recorded, we have classified, and we have summarized the information of the day-to-day operations of the business, okay, which we were having the money transactions or the events which were having the financial characteristics. And we have prepared the final accounts, that is the profit and loss account and the balance sheet. So that is basically the financial accounting. Now in the management accounting is the presentation of the accounting information in such a way as to assist the management in creation of policy and day-to-day operations of an undertaking. This is the definition of the management accounting given by the Anglo-American Council of Productivity. So what this definition says, the information that we have prepared by the way of financial accounting, now that information is presented to the management, and for what purpose? To assist them in creation of the policy and day-to-day operations of a undertaking. See, what is the information that we have got from the financial accounting? We have got the profit and loss account, which has given us the figure of gross profit and net profit of the business during a particular period, and it has given us the balance sheet, that has given us the status of the assets and liabilities of the business. Now this is the information which in itself doesn't have much value. It is the management which takes into account this information, and then they take the further business decisions on the day-to-day operations of the business. That is the part of management accounting. Management accounting deals with the presentation of the accounting information to assist the management in taking the day-to-day business decisions. So what are the management accounting tools? That is the trend analysis, the ratio analysis, funds flow statement, cash flow statements. These are all the part of management accounting. What are the decisions that are taken on the basis of management accounting? The decisions like make or buy, sell or stop. Means if the organization is making some product and it is using some raw material. Now there is an option also that why not to make the raw material also rather than purchasing it from the suppliers. So how to take this decision, whether we need to keep purchasing the raw material from suppliers and then keep using it to make the final product, or is it better for the organization or for the business to prepare the raw material also by their own? So this is the decision that need to be taken. That is the make or buy decision. There can be some trading firms also. Trading firms means they are purchasing the product and then they are selling it to the customer. Means they are not manufacturing the product. They are simply purchasing it, they are putting their markup and then they are selling it. So for those kind of firms, if there is a decision to be taken, rather than purchasing that particular product, why not to make it and then to sell it? So these are the decisions that are taken on the basis of management accounting. Another decision can be sell or stop. Means there can be a stage in the business when a product is not producing enough profits or it is not generating enough revenue. So there need to be a decision whether we need to keep selling this product or we need to stop selling this particular product. We have seen the example from various organizations or where some products they are being discontinued. So how this decision of discontinuing a particular product is being taken, that is basically on the basis of management accounting. And the input of management accounting is given from the information by the financial accounting. So these are the decisions like make or buy, sell or stop, which are taken on the basis of the management accounting. So we have discussed about the two dimensions, that is this management accounting. Now we are discussing about the financial management. So the financial management means planning, organizing, directing and controlling of the financial activities such as procurement and utilization of funds of the enterprise. See, what is management? I hope you have studied management and you are aware of the definition of the management or the management functions. In case of management, we plan activities, then we organize, then we direct and control the activities. So when these activities are of financial nature, means we are deploying the management principles to finance, then it becomes the financial management. So financial management means planning, organizing, directing and controlling of the financial activities such as procurement and utilization of the funds of the enterprise. It means applying the general management principles to financial resources of the enterprise. That is the same thing that I have spoken earlier, that we are employing the management principle to the financial resources. So in financial management, there are basically three decisions that we need to take. First decision is financial decisions. These are the decisions that relate to how to raise funds, means how to get the funds for the business. Now there can be short-term sources, there can be long-term sources. So how much of the funds to be raised from short-term sources, how much of the funds to be raised from long-term sources. Again, in the long-term sources, there can be debt mode, there can be equity mode. In debt, we can take the loan, and in equity, the business ownership is shared by the way of shares. So again, a decision need to be taken. If we are raising the funds using long-term sources, then how much of the funds to be raised by using debt, and how much of the funds to be used by the way of equity. Even if we are using the short-term source of funds, then how much of the funds to be raised by using various sources of short-term funds. So these are all the financial decisions. That is basically about raising the funds, how to get the funds for the business. The next decision in financial management is investment decisions. See, in the first part we have got the funds, whether from short-term sources or whether from the long-term sources. The next decision is how to allocate those funds. Now again, in the business we have two separate activities. Like one is the day-to-day business operations, and then there are other longer plans like how to expand the business. So we need to decide how much of the funds to be allocated for the day-to-day operations of the business, how much of the funds to be allocated to the expansion and other capital generation of the business. Like the expansion, if you want to purchase new machinery, then it is basically the long-term use. And if you want to pay the electricity bill, that is basically the day-to-day operations. So in the investment decisions, we need to see the funds raised in the first decision, that is the financial decisions. We have raised the funds by the way of short-term and long-term sources. Now how to invest those funds, how much of the funds to be utilized in day-to-day business functioning, like paying the electricity bill, like paying the salary, etc., and how much of the funds we need to utilize for the business expansion, for the procurement of new machinery, for the procurement of new land, for the new product development, means for the long-term purposes. Now the third is dividend decision. See, we have raised the funds, we have invested those funds, and we have got some profits. Now this third decision, that is the dividend decision, it deals with the profits. After raising funds and employing them, deploying them for the business, and the after successful business operations, we have come up with some profits. Now what to do with those profits? This is basically the third decision that the financial managers or financial management deals with. One option can be the profits, they can be given back to the business, means the profits, they can be utilized as internal sources of funds and they can be plowed back into the business. Another option can be the profits, they can be distributed among the promoters, among the shareholders. See, if we take the first decision, the entire profits, they will be channeled back into the business, means those profits or those funds, they are utilized. We again go for the investment decision, means those profits, they are invested within the business, and then we go take the decision with regard to how much of those funds need to be invested for the purpose of day-to-day operations and for the purpose of capital expansion or business expansion. But if we go for the second decisions, means the profits need to be distributed among the shareholders, then again there are separate decisions. How much of the profits to be distributed, whether 100% profits to be distributed or a specific percentage of profits to be distributed. So suppose if we have decided that a specific percentage of profits to be distributed, 50% of profits to be distributed and 50% will be invested back into the business. That is the dividend decision. Now we have decided that 50% of profits to be distributed among the shareholders and among the promoters. So the next decision will be how this division will take place, how you are going to distribute these 50% profits. So these are all the decisions that are basically the dividend decisions. So in the financial management, we have gone step by step. First, we have gone about the raising of funds, that is the financial decisions, how to raise funds. Then we have gone for the investment decisions, how to allocate those funds among various business heads, like for the day-to-day operations and for the capital management, assets creation for the business. And the third decision is when we have raised the funds, we have invested the funds and we got with some profit, how that particular profit, what to do with those profit, whether to invest them back into the business or whether to distribute those profits among its promoters, owners or shareholders. So these are the three decisions that the financial managers take. Now another important aspect is financial planning. See, in financial management we have used the management principles or management functions for the financial part, and the first part was planning. So financial planning, if before going for the financial planning, let us see what is planning. Planning is always future oriented, means we are deciding in advance what to do, how to do, when to do. So the financial planning in simple words can be defined as the process of estimating the capital required and its composition. Means we are taking the future decisions with regard to finance. There are two aspects, that is estimating the capital required, means how much of the funds will be required in future, and its composition, means how those funds will be raised. Composition here means how much of the funds will be raised from the short-term sources, how much of the funds will be raised from long-term sources. If long-term sources, how much of the funds will be raised from debt mode, how much of the funds will be raised from the equity mode. So financial planning is about making these decisions in advance. It is basically the process of framing policies with regard to procurement, investment and administration of funds of the enterprise. Again, the three aspects: first we need to procure the funds, then we need to invest those funds, and then the administration, means coordination and control aspect. According to Cohen and Robinsons, the financial planning should, the first part, that determine the financial resources required to meet the company's operating program. Means we simply need to determine the requirement, how much of the funds will be required. Then the forecast, we need to make an estimate. See, we have decided on the requirement, then we need to forecast the extent to which these requirements will be met by the internal generation of funds and the extent to which they will be met from the external sources. So first we have decided on the requirement of funds, that these much of funds will be required. Then we forecast that out of these required funds, this much of the funds will be generated from internal sources like the profit or owner's capital, and this much of forces that this much of funds they will be raised from the external sources. In case of external sources, again it can be short-term or long-term sources. Then we need to develop the best plan to obtain the required external funds. See, internal funds the business can arrange, and for the external funds we need to develop the best plans. Then we need to establish and maintain a system of financial control governing the allocation and use of funds. Also, we need to formulate programs to provide the most effective profit, volume and cost relationship. Then we need to analyze the financial results of operations, and then we report the facts to the top management and make the recommendations on future operations of the firm. See, in the financial planning we have discussed that first we need to forecast, we need to make an estimate how much of the funds will be required. Then we need to make the forecast, or we need to make a decision in advance how much of the required funds will be created from can be raised from the internal sources, how much of funds need to be raised from external sources. Then we need to make a plan how to raise the funds from external sources. Then we need to make a system that governs or that controls the allocation and use of funds. Then we need to analyze the financial result of operations, and the facts need to be reported to the top management. So these all are the various aspects or various functions or various parts of financial planning. So in this lecture we have spoken about what is finance. We have discussed the dictionary definition of finance as the noun, that is the management and science of money, and we have discussed its definition as a verb, to procure, allocate the funds. Then we have spoken about the three functions of finance, that is the management, accounting, that is the financial management and financial accounting, and in the end we have spoken about the financial planning. Thank you.